Hello students, greetings of the day. St. Joseph's College for Women Autonomous Vishakhapatnam welcomes to St. Joseph's open web-based learning platform. So e-learn for a soulful and enriching e-learning experience. Department of Commerce and Management of St. Joseph's College for Women Autonomous presents SMOOC, St. Joseph's Massive Open Online Course. I am R. Pavani, Assistant Professor, Department of Commerce and Management of St. Joseph's College for Women Autonomous Vishakhapatnam. Would like to teach you third module, Accounting Principles in Introduction of Commerce. Introduction of Accounting is the submodules of the third module, Accounting Principles. The outcome of the introduction of accounting is explain the meaning of business transaction, explain the meaning of bookkeeping, identify the need of bookkeeping, describe the objectives of bookkeeping, define the term accounting, discuss the objectives of accounting, describe the advantages and limitations of accounting. So the contents of this submodule are understanding the core elements of business transaction, meaning and definition of accounting, objectives of accounting, advantages of accounting, and limitations of accounting. So first of all, I would like to explain you what is a business transactions. Business transaction means the transactions which happens in the business, means purchasing a goods, selling a goods, paying salaries, paying wages, paying charity expenses. All these transactions which involved in business is called as business transactions. So these transactions which are exchange of goods and services and which are monetary in nature. So these transactions may be a cash transactions or credit transactions. Cash transactions involves payment of cash and receiving of cash. Credit transaction involves the buyer will not pay cash but the seller will receive a cash after some time, but he will sell the product to the buyer. So all these transactions may not be remembered by the businessman because every day he will do n number of transactions. So it is not a matter of one day of a business. Business in the sense it will be go on every day for n number of years or n number of days. So all these transactions should be recorded in the books that will be called as record keeping or a bookkeeping. Bookkeeping is a systematic recording of all financial transactions of a business. It involves recording of all the financial activities such as sales, purchases, receipts, and payments. It will maintain the transactions up-to-date financial records of the organization. The need of bookkeeping is as follows. It will be helpful to assess the financial position of a business. Every businessman is very enthusiastic to know either his business earns profits or losses. With the help of bookkeeping, business can avoid the unexpected losses. And it also helpful to make business decision because bookkeeping will provide the data for the future decisions. Either business can expand or it had to be closed. And it also helpful to file the income tax returns by using the recorded data. And bookkeeping is also helpful to prepare a budgets. It also helpful to ensure accurate tax and also helpful to the management. The objectives of bookkeeping is as follows. It uses to show the permanent record. Bookkeeping is to record business transactions in a proper books of accounts which can be kept safe for a number of years. And also it is using to determine the business profitability through financial statements. To know the financial position of a concern, every business organization have to prepare profit and loss account and balance sheet. And also helpful to provide a snapshot of net capital through balance sheet. It will be helpful that how many assets purchased by the business and how many loans have to be paid by the business. And it also helpful to know the sales and purchases of a business, and in that sales and purchases how many cash sales and how many credit sales are there, and also helpful to clarify the creditors and debtors of the business. So, bookkeeping focuses on recording and organizing financial transactions. Accounting is a broader term than bookkeeping. Luca Pacioli is known as father of accounting. So students, first of all, we will see what is the definition of accounting. According to the American Institute of Certified Public Accountants, accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are in part at least of financial character and interpreting the results thereof. American Accounting Association has defined accounting as the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of the information. Here in the definition, identifying transactions means all the activities which are related to the business should be identified, such as sales, purchases, payrolls, etc. Recording transactions means once the transactions were identified, it should be recorded in the books of accounts. After recording, the transaction should be classified as assets, liabilities, revenue, and expenses. After classification, the transaction should be summarized in the form of financial statements like profit and loss account and balance sheet. After summarizing, the financial information should interpret the results to the management. Then the same will communicate to the people who ever interested in the business results. Students, now let us see what are the objectives of accounting. The objectives of accounting are to maintain records of business transactions. The objective here to ensure accurate and complete records of all financial transactions, facilitating the tracking of income, expenses, assets, and liabilities. The next objective of accounting is to ascertain profit or loss of a business. It involves determining the financial position of the business over a specific period. That specific period means 1 year time, that is a 12 months period, which will be called it as financial year. In that financial year, we will be able to know either the business is earns profits or losses. The another objective of accounting is to assess the financial position of the business. Accounting aims to present the financial position of the business on a specific date. At the end of every year, every businessman can be able to determine how much assets were held by the business and how many liabilities have to pay by the business. And also helpful, it will be facilitate decision making. It provides a financial insights to the management in strategic planning and as well as operational decisions. Now we will discuss about what are the advantages of accounting. The first advantage of accounting is it will helpful to the management. It provides a management with a precise information of everything of financial transactions. The accuracy of result is very reliable financial statements that reflect the true financial position of the business. And also it will be helpful to do the comparative analysis and enables comparison of the current performance with the past performance and with the similar organizations. and it will be act as a legal evidence, serves as reliable evidence in court due to the systematic recording. It helps in settlement of the tax matters with authorities through properly maintained records. And it promotes transparency by providing clear and detailed financial records. And also, it will be helpful to evaluate a company's profitability, liquidity, and solvency. This assessment helps in identifying strengths, weakness, and areas of improvement. Now, we will discuss about limitations of accounting. The limitations of accounting is the first one is timeliness. So, accounting mainly records only the past financial transactions, provided limited insight into future performance. So, mostly the historical focus can be less helpful for predicting future trends or making forward looking decisions. The another limitation is it does not record any non financial information. It emphasizes only financial data and often overlooks non financial factors such as employee morale or market conditions. This can result in an incomplete view of the company's overall performance. The another disadvantage is personal judgments. Financial reports can be manipulated through creative accounting practices or intentional misstatements. This can mislead stakeholders and compromise the integrity of financial information. The another disadvantage is it relies on estimates and judgments such as depreciation and asset valuation. These estimates introduce subjectivity which can affect the accuracy and reliability of financial reports. And accounting focuses on financial transactions and may not address qualitative factors for long term strategic impacts. Check your progress. Accounting is the process of recording, summarizing, analyzing, and reporting financial transactions of a business or organization. It provides critical information to stakeholders like owners, investors, managers, and regulators for decision making. The purpose of accounting is to track financial performance and position of a business and to support planning, control, and decision making. So, the activity of this submodule is define accounting. Find out the advantages of accounting. Observe in any shopping mall or departmental store or grocery store either they are maintaining accounts or not. Thank you, students. Happy learning.